Oliver, we've heard so much about these UK banks over the last couple of months, and mostly bad news and mostly very little to do with underlying operating performance, PPI, trading glitches, system downgrades and crashes. But how are banks like RBS and Barclays and Lloyds actually doing?
Well, underneath all that rubbish, all of the charges and all of the mis-selling and that kind of thing, we've had a look at the underlying picture over the first 9 months of the year, and unfortunately it's not great. Things are looking fairly static to slightly down, certainly from RBS and Lloyds, which have been out yesterday and today. Both of them are reporting slight declines in their overall income from their core businesses. These are the ones they'll retain. And also slightly lower margins. It's very hard to run these sorts of businesses in this kind of low interest rate environment, so it's hard going out there for them.
And some viewers may not understand that a big part of what retail banks do is provisioning for potential bad loans, and a big driver of profits for both these banks is that that provisioning is declining. Is that right?
Yeah, absolutely. Particularly for Lloyds, it had a big increase in profits yesterday because it's losing its provisioning is going down, which is great news. It's showing a lot of lending discipline, obviously, which is nice news. But there's only so long that falling provisions can help to keep profits moving forward. At some point, you need the top line, you need the actual loan growth to push things forward, and we're not seeing that coming through at the moment. Indeed, at Lloyds, they're deliberately trying to reduce their market share in mortgages for the moment. So we'll see interest income falling for a bit.
And forget about the businesses that the banks are calling non-core. How successful are they being at cost cutting in their sort of ongoing businesses?
Yeah, pretty successful at both. The cost to income ratios are looking fairly okay at both. So those sort of internal things are going well. But overall, they need an economic improvement so that they can increase lending again. That's, I think, what will drive them forward more.
And that Santander looked at the UK market and perhaps said no thanks. Does that give you any indication of just how difficult UK retail banking still is, do you think?
Partly, it gives you an indication of where Santander is and where it sees its risk, and obviously doesn't want more exposure to UK retail. For RBS and Lloyds, it's not a question of whether they want to be in or out. UK retail is by far the biggest part of their businesses, so they don't have that sort of choice to make. But obviously at the moment it's a very tough place to be operating.
And there's been a very strong share price rally since the beginning of the year. How do the valuations now look on these companies?
Well, Lloyds is the really strong performer. Its shares up over 60% this year, so it's been a good investment if you bought on the 1st of January. Lloyds is now at a premium to RBS and the rest of the UK listed banks. It's on about 0.7 times book value, so it's a slight premium to the rest. I'm not sure it can trade at much more of a premium than that. It's had a decent set of results, but not that much better to command a bigger premium than that.
Well, some good news for the government at least in the last few months. Thanks very much, Oliver.